Traders Corner is proudly brought to you by IG, the specialists in CFD trading.
Welcome to Traders Corner, and as always I'm joined by Garth McKenzie, founder and editor of Traders Corner. This is a pre-recorded show this week. Garth will in fact be sunning himself on some exotic beach location somewhere. Garth, welcome. Garth, so we flagged the fact that this is going to be an educational show, and I know that there are 4 sort of trading setups that you would like to go through that for you are very high probability setups, and it's always good to have these in the back of one's mind when one is trading a stock. So let's kick off with the first of those setups.
Yeah, I'm going to look at four different setups. I think it's always a good idea, if you're a trader, try and sort of have a trading plan and know what type of setups you use to trade. And I think that I'm going to show you 4 setups here that, quite honestly, to me are very high probability trade setups. And if you only stuck to these 4 setups and traded them with discipline, you'd probably be quite a successful trader, rather than trying to force trades and find funny reasons to enter trades. So have a look at these 4 setups,
okay.
And then let's take it from there one by one. The first trade setup that I'm going to talk about here is quite simple. It's buying off trend line support. Very, very simple, and the illustration is there. Basically, it's assuming that a stock is in a rising trend. It rises, pulls back, rises, pulls back. What you can do is you can typically draw a trend line through the low points of a stock that's in a rising trend. The important things to remember here are that you need at least 2 points, but preferably 3 points, to join together to form a trend line. And the more points you can get to touch, the more relevant the trend is, and the stronger the trend is.
In other words, when people talk about a trend being firmly established, that's what they're referring to?
Yes, exactly. A trend being firmly established is where you've got something like this very basic illustration, but it shows you how the low points or the pullbacks in this share price pull back to trend line support, then find support, and then move up. And the thing to always remember with a setup like this is you must join the low points. And we're talking about a rising trend here, obviously. I mean, we're not talking about downtrends, which are a separate topic. We're talking about a rising trend here. You join the low points. Don't cut through the data, etc. You must join the low points. And as I say, preferably 3 points or more to establish a strong trend. And what you need to always say to yourself when you see a setup like this is, what is happening at a level between buyers and sellers that's creating this trend? The fact that the trend is rising, like in this illustration here, it's telling you that the buyers, on average, are stronger than the sellers. Okay. But yes, you do have those short-term pullbacks, but net, the buyers are the stronger force. So you want to join that stronger force. You want to join that momentum. So what you would typically do in a situation like this is look for pullbacks towards the uptrend and then wait for a clear reversal. A reversal is an indication that the buyers have begun to take the upper hand and they've started to take the stock up off the trend line support. And what it means is that you've got acknowledgement from other market participants that your support level is actually being held.
So whereas you might maybe make the most gains if you bought on the support and the stock were to rally from that level, your gains might be comparatively better than if you bought as it's starting to reverse up off that support line. But generally, it's probably safer to buy once it's already started moving up, because you kind of get a sense that it's going in the direction you want it to.
Yeah, that's right. We always look for what I call reversals. So you're not going to just go and blindly pick a level and say, well, it's at the support, let's just buy. And what you're going to do is wait and see and notice that other market participants are also buying and that there's some evidence of support being acknowledged at your trend line. If we look at an example of it, to have a look at Aspen. Now, this is a stock that we've traded successfully on the show. Now, we've got an open position in it at the moment, and we've traded it successfully on previous occasions as well. Here you can see an example of a stock that's in a very well-defined upward trend. Notice the arrows there. Each time the share price has pulled back towards this uptrend support, there's been buying activity to come in and take that share price higher. And this one up here recently in late March was the one that we've bought for our portfolio. And we didn't buy the exact bottom on this. We bought it once it had shown evidence of reversing up, and once it was evident that other market participants were also buying the stock, and that we weren't alone in our view that it was worthwhile buying off that support level.
Yeah, heaven help you if you're alone in the market, although sometimes it can work to your advantage.
Yeah. And then the last point, just sorry, something we haven't yet mentioned about this is that if you do this, of course, it's not going to work every time. I mean, this is a high probability setup. It works most of the time. But there are times when your trends eventually break. And that's why you need to then have a stop loss below the trend line or below your reversal point. So in each of these instances here, you would have looked for evidence of a reversal, wait for a reversal candle to occur, and then buy. And then you would set a stop loss underneath the lowest point of that reversal candle. And that's what we've done recently with our Aspen trade, and so far so good. It's working for us.
Yeah. Okay, Garth, the next one is a triangle. Which may be a little bit harder to divine in the market than a clear trend line. So what's that all about?
Yeah, these next three that we're going to talk about are actually all of them are continuation patterns within a trend. So we're looking at triangles first, and then we'll look at flags and wedges after that. So a triangle pattern is, as the illustration looks on the screen here, you can see it basically says that the stock is in a rising trend. It then enters into this consolidation period where it forms a triangle type of pattern. And then ultimately, the higher probability outcome is that usually the share price will continue in the direction of the trend that it was going in before the triangle consolidation formed. So in other words, in this case, we've got a stock that's in a rising trend. It consolidates. The highest probability is that it will continue out and break out in the direction of that trend, as this illustration shows. So a couple of important things to note with triangles. First of all, there are usually 5 waves or 5 moves within a triangle structure. And you can see them labeled there, 1, 2, 3, 4, 5. The 5th wave is usually the one that breaks out. In a perfect textbook triangle setup, the 5th wave is the one that breaks out. Then your breakout should usually occur around about 2/3 through to the apex of the triangle. So what I'm saying there is if you took these 2 yellow lines that define the outer boundaries of this triangle, and you projected them out to an apex, what it's saying is that this breakout, this 5th wave, actually breaks out more or less 2/3 of the way towards where the apex of that triangle would meet up, as it were. That's a high probability triangle setup. You want it to break out on the 5th wave more or less 2/3 of the way into the apex. And then your target for a triangle pattern is taken as the height of the triangle at the broadest point. So in other words, at the beginning, up at the top of wave 1 there, essentially. You take that same distance and then you project that distance up from where the breakout occurs, and that then gives you your triangle target. Now, in terms of how you trade these things, you'll wait for the 5th wave breakout to occur. That's the safest thing to do. So wait for that breakout and then buy it on the breakout through the top of that triangle structure. You'll then set a stop loss down underneath the lowest point of that 4th wave before the breakout occurred. Usually you'll find that these setups give you a risk to reward ratio of 2:1 or better than 2:1 in most cases. And the other important thing to note with a triangle structure is that statistically these things work around about 66% of the time.
Okay.
So 2 out of 3 trades essentially
Not bad.
will break out in the direction of the trend and will meet their target. Of course, that also means that 1 out of 3 of them don't work. But that's why we have to have stop losses. And there's no guaranteed setup of anything in the market. But this is certainly a high probability setup that we're talking about here.
Garth, but very quickly, before we go into an example of where you would find this in the market, if you didn't have that 5th wave, say that 5th wave faltered at that point where you've got the top yellow line and started heading down again, that presumably would be then a negative setup because you would have a succession of lower lows, and that presumably is not what you're looking for.
Yeah, look, it can happen that it fails at that resistance, the top line, the top resistance line, then turns down and actually breaks out the bottom. But remember that what I was saying is that happens usually in about 1 out of 3 instances. 2 out of 3 instances, or 66% of the time, you'll find that your triangle actually breaks in the direction of the prevailing trend. So the higher probability outcome here is actually to buy the triangle on a break to the top side.
And a stock that would illustrate this?
So a very good example recently has been EOH, and there was a small little triangle that formed here towards the end of March. And if you have a look, there it is, identified there, the 5 waves, quite clearly illustrated, 1, 2, 3, 4, and then the 5th wave it breaks out. Also notice I've taken those lines that define the triangle structure and I've actually projected them out to an apex point. And what you can see is that 5th wave breakout occurred round about 2/3 of the way into the end of the triangle structure. So a perfect triangle, textbook triangle pattern here. And the way you would trade this is you'd buy on that breakout, and we actually did highlight this for subscribers of traderscorner.co.za. We highlighted it. We said you would buy a breakout to the top of that triangle through 155 Rand, and then your stop loss would be down below the bottom of the fourth wave there, which was at about 149 Rand. And we're looking at a target here in the sort of the upper 160, about 168, that sort of area. As a target.
All right, so you talked about three sort of continuation patterns. So the next one is a flag, and you talk about bull flags and bear flags, but presumably a bull flag here.
Yes, in this case we're looking at all these setups are bullish setups, so this is what's referred to as a bull flag. And again, it's a continuation pattern within a rising trend. So as the illustration shows, you've got a stock that's rising, it then consolidates for a while, almost pauses, catches its breath, and then there's usually a break in the direction of the prevailing trend again. So you can see that the flag rather is highlighted by these yellow trend lines over there. The boundaries of a flag are usually parallel.
Okay.
All right. And to get a target from a flag pattern, usually you take the height of what's called the flag pole here.
Yeah.
So that's that leg, that up leg before the flag began. Take that distance and project that same distance from the bottom of your flag structure out to get a target. And there's sort of a saying that sometimes flags fly at half mast. And that the reason for that is you can see that structure, once it's completed, once it's met its target, the actual flag is sitting halfway between the bottom and the top of that setup.
Okay.
All right. The way you trade a flag structure is you'd wait for a breakout through the top of that flag pattern or through that channel, if you like. That's where you buy. All right. It's safest to wait for the breakout to buy. You'll then set a stop loss underneath the lowest point in the flag before the breakout occurred. All right. And then obviously your target is up at the higher levels here. And usually you'll find that you can get also about a 2-to-1 or 3-to-1 risk to reward ratio on these setups. And again, they work about 65% of the time. They break in the direction of the trend and go on to meet their targets.
And the stock that you've got there, it looks redefined.
Redefined,
so
yeah, listed property stock. So this is actually a trade that I did earlier, not for the show, but I did it for myself in December or into January this year, actually. And what you can see quite clearly evident over there is there's your flag structure. And notice how you take the height of that flagpole, take it from the bottom of the flag structure, and you project that up, and that's your target. And it got to that target quite quickly, and then it sort of consolidated for a while, and then actually formed another flag type pattern. Redefine's formed quite a few flags actually over the last number of months. If you look back, you can see a couple of them. But that's the one that I specifically highlighted over there. And in this case, the idea was to buy on the breakout at 10 Rand 80. Stop loss was at 10 Rand 60. And the target that we looked at for here was about 11 Rand 60 or thereabouts.
Okay, and then Garth, the last one is a wedge pattern.
Yeah, a wedge pattern in some respects, I suppose it's a bit like a flag and a bit like a triangle, a little bit of a hybrid of the two, I suppose. A wedge, it looks as follows. Again, it's a continuation pattern within a rising trend. In this case, it's a falling wedge. You get falling wedges and rising wedges. A falling wedge like this is typically a continuation pattern within an uptrend.
Okay.
A rising wedge is often a continuation pattern within a downtrend.
Okay.
All right, so this is a bullish pattern as we see it here. You can see the stock rises, it then spends a bit of time consolidating, and then ultimately it breaks out again in the direction of the prevailing trend. Your wedge formation is usually, it actually forms slightly counter to the direction of the prevailing trend, as you can see here. And you'd want to buy the breakout in the direction of that prevailing trend. Usually your target for a wedge structure is actually a move back to the point where the wedge began to form. So in this case, you can see it starts there, then it consolidates. The breakout would then, you'd expect a move to basically go back and meet the previous high. That's how you'd look for a target in the case of a wedge. And this is a minimum target, by the way. All of these targets I've been talking about are minimum targets. It's not to say that the share price will stop there forever.
Sure.
But it probably usually get there and then consolidate a bit more.
In fact, as evidenced by all the stocks that you've highlighted.
Exactly.
And
yeah.
where would your stop losses and buying in points be?
So you'd look to buy on the breakout through the top of that wedge structure. And then once you've done that, your stop loss will be below the lowest point of the wedge previously to where the breakout occurred. All right, and you can see it quite easily illustrated there. And usually these wedge structures actually give you a good risk to reward ratio. Normally about 3-to-1
Okay.
risk to reward ratio, which is a pretty good a pretty good risk to reward ratio on any trade.
And just to end off with the share that highlights this for you.
Yeah, so recently we've got a share price of Mondi PLC here.
Okay.
And we highlighted this for our subscribers on Traders Corner towards the beginning of April. You can see the wedge structure that formed here. It's generally a rising trend. The stock was consolidated into this wedge pattern, then it breaks out. And the idea here was to buy the breakout 231 Rand through the top of that wedge structure. Your stop loss will be down below the bottom or the lowest point within that wedge before the breakout occurred, which was 227 Rand. And then you're looking for a target of 252 Rand here, which is equivalent to the previous high.
Yeah, you make it look so easy, Garth.
Trading shouldn't be that difficult. It's not rocket science.
No. Garth, we'll leave it there and we'll be back next week, Tuesday. Thanks as always for joining us. Garth McKenzie is, of course, founder and editor of Traders Corner.
Traders Corner is proudly brought to you by IG, the specialists in CFD trading.